Hello everybody and welcome to this new video. So first of all, let me start by saying that none of this is going to be neither investment advice, tax advice, lifestyle advice, none of this. This is just for entertainment. Now that I've put that out of the way, let me tell you a little bit about how I view tax loss harvesting and especially in the downturn, how I view it in the downturn. Because I typically am not the type of person who wants to sell a stock until my thesis is busted. As long as my thesis is good, I want to keep the stock. But the problem right now is that we've had indiscriminate, insane, broad-based selling, right? That has nothing to do with underlying company performance. Like the Nasdaq, and I guess it's been up for the past 2 weeks, but it's been down more than 30% essentially since the beginning of the year, and the drop started really early November. So if you go back to early November, it's down even more than that, and it's been entirely indiscriminate. Like every single stocks have been down because of macroeconomics, right? Whenever Jay Powell says anything about the recession or about his views on inflation, boom, the market crashes. But that has very, very little to do with our stocks and with these innovative companies, which I think are the future. That has nothing to do with that. Yet it has an impact on your portfolio. And there's decisions that I think we can make to improve returns. And I just want to walk you as to how I view tax loss harvesting. And so, again, much of the selling comes from people selling the broad-based indices. There is no or little to no individual stock discovery right now because people are so short term. They're just thinking about the next Fed meeting. And any scare, any CPI data, anything related to inflation, jobs, moves the market. But it's like there's almost no long-term research done anymore because everybody's so scared. It's a highly fearful market. And so in these conditions, it may make sense for you to concentrate on your highest positions and your highest conviction, even if you still believe in the stock that you initially had invested in. Whenever you notice discrepancy in how far certain stocks have fallen compared to other stocks, it may make sense for you to sell the stocks that you don't like as much for stocks that you like more and engage in a tax loss harvesting strategy. And I just want to walk you through two examples of moves that I've done in my portfolio. And we know that in down years, in recession years like the one we have right now, we know that a lot of savvy investors adjust their stocks. And you may be the type of investor who never sell anything for 10 years because we've had a wonderful rise in the markets. And then you have a crash like this that happens. That's the moment to relearn about tax loss harvesting, things that we haven't had to do in the past few years. That's the moment to relearn that. So I just want to focus on a few things that I've done. So for example, let me show you kind of an extreme example. I like both Palantir and Snowflake. I think Snowflake right now is more in line with the market. Palantir is more for a long-term bet. They focus on kind of different stages of the data transformation of a corporation. Palantir is more of an AI-based running the corporation software, while Snowflake is more of a data lake or database. So a little similar and yet distinctive stocks, distinctive companies, and this distinctive focus. Yet I've noticed right now that Snowflake, and I'll post a video in the description that I've done on it, Snowflake is doing amazing. It's doing really, 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 really good. And right now, Palantir, the reason why I've invested in Palantir was the commercial revenue, because I want to see commercial revenue growth. They've actually seen a decline in their commercial revenue growth. So I'm not very happy with Palantir right now, and I am very happy with Snowflake right now. But neither of these stocks have a busted thesis. Like both of these stocks are still, over the long term, I didn't see any break of the thesis. But over the short run, Snowflake is doing better. Yet, look at this. I mean, this is stunning. This was a week ago. This is stunning. The performance is the same. Like the market has put these companies into the same bucket. So Palantir, which has not been doing as well lately, is at minus 61%, and Snowflake is at minus 61%. I mean, it's kind of crazy. Like, look, minus 61 0.1% and minus 6.9. So does it make sense? Even if I'm happy with both companies, does it make sense to sell a little bit of Palantir to buy Snowflake? And the answer to that is yes. Yes, it does, because you are booking a 15% loss. But then you're going to be able to claim on your capital gains in later years. Like in later years, when you hopefully make capital gains, you can claim these losses. And the stocks are highly correlated, right? So I'm still exposed to the upside on data stocks. Like if anything makes me feel right now is that the data stocks move in sync. The data stocks are like so correlated. So it's like I by moving from Palantir to Snowflake, if there is a change of sentiment right now on data stocks, I will get the upside with Snowflake just like I would have gotten the upside with Palantir. So it makes sense to earn 15% on your loss or get back 15% on your loss by switching the company and by going for a slightly different company in a related field, right? So you get a theoretical 15% payout just for switching, for thinking in pairs. So when you think about the pair of stock Palantir versus no, I think it makes a lot of sense. And it's even more meaningful if you live in a state that has state taxes, right? Like if you don't live in Florida, Tennessee, or Texas, you're going to have to think about the 5%, sometimes 10% capital gains on your state tax. Like California, for example, has very high state taxes. So it makes even more sense. This example makes even more sense in a high tax state. But let me move on. That's not the only way. I have another example, which is, and again, we begin with the analysis. So I had a small position in ARKF. I bought into the ARK Invest fintech ETF because, 12, 30 minutes ago, I didn't invest much time researching fintech. It takes a lot of time to really analyze a stock and decide to go invest in an individual stock. And so I didn't have much time to do that, and I decided, okay, I'm just going to buy the ETF. But recently, I've spent as fintech has been entirely destroyed in the market. I've spent more time studying fintech, right? Investing dozens and dozens of hours in different stocks. And so I became more confident about investing directly in certain fintechs, in the fintechs that I think are going to be the winner. For example, SoFi or Block, formerly Square, the Cash App. I really believe in these two as perhaps two of the main financial institutions, top 10 financial institutions within the next 10 years. So it makes sense for me. So I've built my position in those stocks, and I really don't have a use for ARKF. And I'm satisfied with my exposure to fintech in individual stocks. So I don't have a use for ARKF anymore. And concurrently, I grew my conviction in Tesla. I became even more bullish on Tesla. I really like the way Tesla is headed. Became much more bullish about their numbers, production numbers. Everything's really great for me as far as my view of Tesla. So what do I do in this situation? Well, you may be tempted to say don't do it because ARKF fell 67% this year, and Tesla only, it's funny that I say only, but Tesla only fell 53% this year. So again, this has nothing to do with the real world. Like fintechs still have and even have a better potential to disrupt legacy finance right now than they had 12 or 13 months ago. And Tesla has an even bigger shot at disrupting the field of transportation and disrupting legacy auto companies much more than it even have 12 to 13 months ago. But the stocks are down. One of them is halved, and one of them has been almost divided by 3. So it's insane. So would it make sense to take a huge loss on ARKF to buy Tesla for a big discount, but not as big of a discount as the loss? And at first glance, you would say, no, because look, if you, and I'm just assuming you had invested $1,000 on January 1st. So assuming you had invested $1,000 on January 1st on ARKF, on the ARKF ETF, and you sold now, that would be a $670 loss. In exchange, if you were, and I think in pairs again, if you were to sell, take a $670 loss to buy Tesla, Tesla is a $530 discount. So the delta is pretty big between those two. You're like, okay, well, I still have a pretty meaningful loss by doing that switch. But that's because you're not taking into account tax loss harvesting. If you take into account tax loss harvesting, you realize that, okay, your ARKF loss is actually only going to be $569 because you're getting 15% back as a write-off on your taxes. And whether you recognize it this year because you have other capital gains, or whether you recognize it in upcoming years when you sell stocks at a much higher price when the market eventually rebounds, doesn't really matter. Like theoretically, you're going to get 15% of that $670 loss back. So when you adjust for the tax harvest, when you adjust for that, you realize that you're really losing only $569 by selling ARKF, and you're getting $530 off by buying Tesla. So if you do that switch, even though it looks like you're making a much bigger loss compared to the gain you're making on Tesla, compared to the discount, it looks like you're making a bigger loss than the discount you're getting. When you adjust for tax loss harvesting, it makes a lot of sense to switch $1,000 between ARKF ETF and Tesla, because it's really cost you about $49 per $1,000. And imagine you do this with a state that has state taxes. It's even more compelling, right? You could go as high as selling a stock that has minus 75% and buy a stock that is minus 55%, and you would still have a 1-for-1 swap or a 1-for-1 pair trade. So it makes a lot of sense to think and analyze your positions and make decisions within the context of pairs, of using two pairs, and really thinking about the fact that really stocks are down across the board. Like, it's not really related to company performance right now. It's all related to macro and the Fed. So we have this opportunity to engage in tax loss harvesting. And sure enough, savvy investors have been doing a lot of tax loss harvesting for a long time, right? For most, I mean, I assume this is not new for a lot of people, but I wanted to make a video here for the channel. So what are my final rules of thumb? So always start with reasoning. You always want to do a qualitative analysis. It always starts like this, because you don't want to sell a big winner. So it always starts with a qualitative analysis, reason before math. Once you've analyzed kind of stocks that you like less and kind of the stocks that you like more, and you've done your reasoning and your qualitative, then you go ahead and sell and buy. But of course, they have to be different assets, right? You can't do this between the Vanguard S&P 500 index and the Schwab S&P 500. They're not different assets. You can't do this. You have to do this on different companies. And that's one of the power of being an individual investor, buying different stocks. You can do that on different companies. If you were to buy back the assets, because I assume you only buy assets that you like to begin with. So if you were to want to buy back an asset that you sold, you have to make sure that you stay out of that asset for 30 calendar days. And that's the wash sale rule. And if you don't, well, you don't get the write-off. So you got to make sure that you stay 30 days out of that asset. And I'll conclude by saying that, yes, my views is when you look at your portfolio, and it's most likely very, very red right now, think about it in pairs, right? Think about it in pairs. Yeah, there's two stocks you like. Make a decision for those two stocks. Does it make sense to sell a little bit of that stock to buy another little bit of that other stock? Does it make sense or not? And that way you can end up making a lot of decisions on your portfolio just by deciding pair by pair by pair and analyzing pair. And one of the main advantages of thinking in pairs and actually not going through cash, because you could sell a stock and then get cash and then wait. One of the better advantages of thinking in pairs is that you don't miss out on huge up days, because with a market like it is right now, you really don't want to be out of this market, because one day Jay Powell may say something and the market may go up 8 or 9%, right? Typically, it's time in the market that matters much, much more than timing the market. So you really don't want to be out on the few days out of the year where the market is up 7%. So that's why it makes a lot of sense to always stay invested and think of stocks in pairs of stock. Think about the relative value of one company compared to another company and not think about the relative value of one stock compared to the US dollar. At least that is how I view tax loss harvesting, and that's how I view thinking in pairs. So thank you so much for watching my channel and my video. None of this has been tax advice, investment advice, lifetime advice. No, this is just entertainment, edutainment. That is all it is. Thank you so much for watching. Don't forget to like and subscribe, and please follow me on Twitter if you can. I hope to post a few threads going forward. Thank you so much and have a great day.